love the channel and find it useful in becoming a happy retiree. Subscribe today. Now, on the flip side of this, we've got to remember the disciplines that we have to instill in order to be successful long-term investors. Some of that discipline is just having the knowledge of how often and how significant these corrections take place, or how often they happen. And then how quickly do they recover? And what kind of environment makes these pullbacks go from bad, and I would argue that we're in a scenario that feels bad, but when do we go to worse? And when do we go to, and this is what you fear when we go through these corrections, you fear, well, when do we go into kind of downright disaster? When does a correction turn into a bear market? And then does a bear market turn into a 2008, when the markets were down over 50%? So some of the discipline in getting through this is just the knowledge of what's happened in the past. And I want to go through that today. I want to talk about the math behind these corrections. Typically, how far do they go relative to how far we've already gone? And then how do we recover? So I want to talk about it today. Number one, why such a significant and rapid pullback? Why did it happen? Why are we in the midst of this? Number two, what do these market pullbacks look like absent of recessions? And that's why it's important to look at what this underlying economy is really doing. Number three, what do stock market pullbacks look like that happen in the midst of a recession versus absent of one? And then obviously, by the way, we've got to talk about the economic numbers. Where do we stand today? And are we headed into a recession or not? All important issues to understand so that you can try to regulate your insular cortex, so you can try to be able to sleep well at night still and not let investing drive you crazy. Wham! Dow down over 3,000 points in just a couple of trading days. I know your emotions are, maybe they're redlining. We talked about how the emotion in the brain of these corrections, and you hear, oh, it's going to be fine. Everything's going to be fine. I did 15 interviews this week, and ultimately the predominant message is, hey, listen, these are viable pullbacks. These are opportunities. But today I wanted to at least start out by acknowledging that these pullbacks, they hurt. When you get a 15 or 10% correction, you see the account value of your retirement money go down. It just hurts. It's not as fun as when it's adding value. And I think it's important just to acknowledge that, because it's what makes investing difficult. We're in a sport that effectively gives you 8 to 10% returns per year. And if it were that easy, then everybody would do it. And if it were that easy, you wouldn't get outsized returns. A CD pays you 1 or 2%. You can't expect 10% without some pain. And again, combination of factors of why this correction happened. We're going to get deeper into this throughout the show and take your phone calls. But one, you've got the worry of the U.S. economy overheating, which is different than the spark of a lot of corrections. Number two, rising interest rates. Rates, as they go up, they can make borrowing more expensive for homes and autos and credit cards. Number three, quite frankly, just long overdue without a correction. I want to give you those numbers. And then let's call this a bonus reason that gets even deeper into the weeds. The match that really lit this fire, esoteric ETFs. And I'll repeat that word with the emphasis on esoteric. Not ETFs that track dividend stocks, not ETFs that hold bonds, not ETFs that we talk about here on Money Matters. I'm talking about SVIXI and XIV and EXIV. These are ETFs and ETNs that were built to bet against rising volatility. Let's look back as we wrap this segment at corrections for some context. Before this recent market pullback, we had gone over 80 weeks without a mere 5% correction. For some context, 5% corrections have happened on average every 10 weeks. We went 80 weeks. We'd gone over 100 weeks without a full 10% correction, when 10% corrections happened on average every 33 weeks. As of last week, both of those correction levels finally breached. It's the 11th of February, and we just experienced the last 5 to really 6 trading days. So we've got to go back all of last week if you're looking at the Dow Jones, was a relative disaster. And if you go back the week prior is really when it all started with jobs report. There was a good jobs report and a productive wage report. So average hourly earnings ticked higher. And remember, we've talked for many years now that one of the scary things about getting towards the end of the economic cycle, and when I say end of the cycle, I mean the end of the expansion before you contract again, is rising wages. So we had a good jobs report, and the good jobs report spooked the market and said, wait a minute. Things are heating up so much that rates will start to go up, and then those rates in themselves can start to cool the economy back down. And that was one of many catalysts for this market to begin selling off. But it just got violent and it got rapid. And I think that's part of the world we live in. The information is so it spreads so quickly, and there's such, quote, perfect information. That just means that everybody knows in an instant about everything that's happening, that these sell-offs they're quick and they're relatively violent. I mean, this week alone, the Dow down 5.25%, the S&P 500 down over 5%, and that was with a 300+ point gain on Friday. Could have been much further. We closed down beyond the 10% pullback level, which is an official correction. It has been a very long time since that happened. So another reason for the exits here is you have traders sitting ready to get out as soon as there was a sign of corrective behavior, because we have gone 2 years without one, that the finger on the trigger, everyone runs to the exit door, everyone stampedes all at once. And that's really what happened just in a few days. 10% gets wiped out of a multi-trillion-dollar market, a $1 trillion+ correction, just like that. And it hurts. And we're going over the reasons behind this and acknowledging that these corrections are not easy and these pullbacks sting, if you will, but it is part of the process. And we know that there's a significant difference between pullbacks accompanied with a recession and pullbacks not accompanied with a recession. So that's really what matters as we try to figure out where we go from here. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.